Are we at the peak and facing the mother of all bubbles? Blackstone strategist Joseph Zidle thinks we are. Zidle says the mother of all bubbles is the sovereign debt market, and it's the catalyst that will likely trigger the next recession. According to Zidle, at the end of any economic cycle, we often get warnings that appear to be unrelated. It's in hindsight that we realize that they were not all random. Investors saw this during the run-up and in the aftermath of the housing bubble, and we're seeing it again now. So, let's take a look. Before I go on, I do want to state that the good news is that Zidle believes a recession will not occur until about mid-2020 or toward the end of 2021. But Zidle believes the recent troubles connected to the end of the current economic cycle are the repo market woes, negative yielding debt, global trade conflicts, and collapsing manufacturing. And as we know, every cycle ends with excess. Reportedly, the recent rise in quarterly profits will boost markets in the near term. Zidle says the first 3 quarters of 2019 faced the toughest comparables since this profit cycle started in 2016. Now, with earnings flat this year, next year, year-over-year comps should be easier. Zidle indicated that stocks tend to rise until about 6 months before a recession, meaning there could be some market gains and new highs likely to be set. And as this chart here shows from Wolf Richter's Wolf Street blog, it shows the ballooning national debt. The debt has jumped by $1.33 trillion over the past year. And this is the debt, which, by the way, just passed $23 trillion, is what Zidle believes will be the catalyst for the next recession. And of course, this is the Fed balance sheet, which is now over $4 trillion, again increasing by over $261 billion in just 2 months. That's $1.566 trillion on an annualized basis. So why is anyone confused as to why the market is going up? Just make sure you get your fair share. And given all of the talk about recession and market collapses, here is one of the very best ways I know how to keep from making fatal mistakes in the market. And as we now know, the S&P 500 closed October with a monthly gain of about 2.04% after a gain of 1.72% for the month of September. And according to Advisor Perspectives, as shown by this chart, and other than by following me on this channel, buying and selling based on a moving average of monthly closes can be a very effective strategy for managing the risk of loss from major bear markets. In essence, when the monthly close of the index is above the moving average value, you hold the index, and a close above the moving average is shown in green. But when the index closes below, you move to cash, and a close below the moving average is shown in red. Now, the natural disadvantage is that it never gets you out at the top or back in at the bottom. But do you know anybody that does? And it can also produce the occasional whipsaw that you see there in the period around 2016. But regardless, as this chart shows, using either a 10 or 12-month simple moving average strategy would have ensured participation in most of the upside price movement while dramatically reducing losses. So stay away from making those fatal errors in the market. And so for today, that's ChewDog Charts. Thank you.